What's going on, Penny Boys and Gals? It's Matt here, also known as What the Duck in the Discord. Today we're going to talk about what commodities are, how they're traded, and the various strategies that traders use in this space. I know we are all familiar with equity stock trading, where it's all about company shares and ownership, but commodity trading is all about tangible goods, raw materials, and primary products that fuel the economies worldwide, which is why learning about them can help your stock trading even if you don't trade commodities. Just like futures trading or forex trading, commodities is a great thing to learn because it's an important part of the economy, and the economy affects the stock market. To begin, let's define what commodities are. In the realm of finance, commodities are raw materials or primary agricultural products that can be bought and sold. These can include items like oil, gold, wheat, and coffee. Commodity trading, of course, has ancient roots, dating back to the earliest civilizations. Initially, this was done through a barter system. I give you X bushels of wheat, you give me X number of livestock. But as societies became more complex and greedy, the need for standardized systems of exchange became evident. This led to the development of early forms of commodity markets, where goods like grains, metals, and other raw materials were traded. Over time, these markets evolved into what we will be discussing today. Commodities can be broadly categorized into two main groups: hard commodities and soft commodities. Hard commodities are typically natural resources extracted or mined, such as gold, crude oil, copper, natural gas, and silver. On the other hand, soft commodities are agricultural products like corn, wheat, cotton, sugar, and soybeans. Now let's talk about the difference between trading commodities and other assets like stocks or bonds. As we know, stocks represent ownership in a company. Then there's bonds, which are debt instruments. There's even crypto, which is digital currency. But commodities are tangible goods. Their prices are influenced by supply and demand dynamics in the physical market. So the price of a commodity is determined by how much of that commodity is available, the supply, and how much it is desired by consumers, the demand. When there is more supply than demand, prices tend to fall. When there is more demand than there is supply, prices tend to rise. Just like with the supply and demand zones. A supply imbalance or zone is caused when the amount of supply exceeds the demand, which is why a supply zone is usually looked upon as a resistance. And a demand imbalance is when the amount of demand exceeds the supply, which is why a demand zone is usually looked upon as the support. The supply, sellers; demand, buyers. Balance between supply and demand is a primary factor in the commodity prices. Commodities are traded through different methods. One way is through spot market, where commodities are bought and sold for immediate delivery. This can be done in a few ways. It's called spot because the transactions are settled on the spot. Participants include producers, consumers, traders, and speculators. Producers sell their excess commodities, consumers buy what they need, traders and speculators like ourselves aim to profit from the price movements of the commodities. The price is determined by the current supply and demand conditions, which determine the market value of the commodity. Spot trading, actual physical delivery of the commodity may happen. For example, if you buy a barrel of crude oil in the spot market, you may arrange to have it physically delivered. However, many spot market transactions are settled via cash. So instead of delivering the item, the equivalent cash value of the commodity is exchanged. This is how traders get involved in commodity spot trading. Traders will buy the commodity and get a receipt that's theirs instead of having it physically delivered. That receipt can be a warehouse receipt. So if a commodity is stored in a designated warehouse, the receipt certifies that the commodity is stored and owned by the holder of the receipt. There's a bill of lading, which is a document often used in the transportation of goods, especially ones that are shipped. The holder of the bill of lading has the right to take possession of the commodity upon arrival. There's also delivery order and certificate of ownership. However, the one that traders focus on is electronic confirmation. That's right, as a trader of commodities, you don't have to worry about keeping track of a receipt or certificate of ownership. In modern trading systems like the one we use, traders receive electronic confirmations or statements from the exchange or brokerage platform. Another significant avenue is the futures market, where contracts are used to agree on a future price for the commodity. This allows for hedging against price volatility. You can also trade commodities through ETFs and ETNs. ETFs are exchange-traded funds. These allow investors to gain exposure to a basket of commodities without physically owning them. ETNs are similar. These are debt securities that track the performance of a specific commodity index. When you invest in an ETN, you're essentially buying a promise from the issuer to pay you in the return of the index minus fees at the maturity date. There are many different brokers that you can use for commodity trading. E-Trade provides access to a variety of commodities, including ETFs and futures. Interactive brokers TD Ameritrade, Thinkorswim, Fidelity, IG Group, Saxo Bank, and TradeStation all have some form of commodity trading. When it comes to strategies or skill sets behind commodity trading, technical analysis takes the forefront. Commodities are heavily influenced by technical factors such as supply and demand, price trends, and patterns. Many commodities also have cyclical nature. For instance, agricultural and natural resources could have cyclical price patterns due to seasonal factors, weather conditions, and economic cycles. Being able to chart these out is crucial. Stocks have companies that release news, are trying to grow, have scandals, but commodities don't have to deal with all that. Instead, they had to worry about seasonal trends, consumer trends, and other factors. Commodities don't have financial statements like stocks, but they are influenced by many fundamental factors. Supply and demand dynamics is the global production and consumption trends for specific commodities. For example, with crude oil, traders can look at the production levels and level of oil inventories as supply factors. And then economic growth, transportation industry growth, others can be seen as demand factors. Geopolitical events can affect both supply and demand. GDP growth, employment reports, inflation rates, and other economic indicators can also influence commodity prices. So can weather conditions, which we don't deal with as much in the stock market, but weather patterns have a direct impact on agricultural commodities. Droughts or floods can affect corn yields and in turn prices. So charting and just being aware of the commodity that you are investing in or trading, that way you can find ways to be on top of the different events that can affect the price. As with any form of trading, managing risks is super important in commodity trading. Use diversification, position sizing, trading psychology, and risk-reward strategies, and apply them to commodity trading. Spot markets for commodity tend to be highly liquid, meaning there's a high volume of trading activity. That's why prices can be highly volatile at times. It's also important to know which commodities have low liquidity, which will make it challenging to execute trades at the price you want, especially for larger positions. In larger positions, many commodities are conducted using leverage. It allows traders to control larger position sizes with smaller amounts of capital. There are more reward opportunities, but of course a lot more risk involved. You also have to be mindful of sanctions, changes in regulations, labor strikes, and trade tensions when it comes to commodity trading, as well as weather and natural disasters, as we spoke about before. There are some advantages of commodity trading as well, such as diversification. This is a different asset class than stocks or crypto, so it is another way to spread out your overall risk. Certain commodities such as gold or oil have historically acted as hedges against inflation. Their prices tend to rise when the value of currency falls. Commodities also give you more global market exposure, giving you exposure to learning about global trends and geopolitical events. This can also help you in your stock, crypto, futures, or forex trading. Some commodities can be physically owned. Crypto traders are all about not trusting the government with their money. Not your keys, not your crypto. Well, with certain commodities such as precious metals, you can store it yourself or physically own it. That way you aren't relying on banks or stuffing money into your sofa cushion. Like we said before, commodity markets can be volatile. That can be a con, but it can also be a pro, because it creates opportunities for traders. Overall, it can add a layer of diversity and risk management to a trader's portfolio, which can be especially valuable in times of economic or market volatility. Make sure to check out our free trading Discord, where we have over 100 classes on trading stocks, crypto options, OTC, futures, forex, commodities, and even NFTs. I hope to see you there, but until then, as always, I hope that you all make some bread.